Hi, I'm George Pino, the CEO of Commercial Brokers International. Today I'd like to talk a little bit about what we've seen over the last quarter in the commercial real estate market, as well as what I forecast for the coming quarter, the third quarter of 2017, for commercial real estate for the west side of Los Angeles, including retail, office, and industrial. The retail submarket within west side of Los Angeles, or in general, has really come under fire lately for the increase in the vacancy rates. And is this really a cause of concern, or is this just a little blip in the radar? So let's explore that a little bit. What I'm seeing right now is we are having a little bit of a turbulent time in that the vacancy rates have jumped almost 20% over what they were previously in the last earlier part of this year. That sounds like a huge number, but when you look at the overall scheme of things, we are currently at a Westside vacancy rate of 4.4%, and Westside being from the 405 west to the ocean and from Brentwood down to Marina del Rey. Other areas, when you expand that market a little bit more, so just east of the 405 perhaps, it can jump as high as 7.5% for the vacancy rates. Now, what does this mean overall? 4.4% on a vacancy rate is actually a relatively healthy rate still. When you look at the five-year average has been only at 6.9%, so we're still below that average. Because of the increase in the vacancy rates, though, we are seeing a little bit of stabilization in the rental rates. Not much of a drop yet, but I do expect that, especially in certain micro submarkets such as the Promenade, where we've seen a much higher vacancy rate come up. And this is primarily due to people either looking to get out of their leases and or leases coming due and the rental rates being so high. Historically, we're looking at $12 to $18 per square foot per month, triple net basis for that submarket, but at the same time I see that having to come down to compensate for the higher vacancy rates that we're seeing over there. So about a month ago, Amazon announced that they were going to acquire Whole Foods. Now, it still hasn't gone through yet. It's subject to regulator approval and as well as the stockholders' approval. But if it does go through, what's that going to mean for the supermarket submarket? Now, overall, in general, even before the Amazon announcement, we saw a big shift toward a lot of the business models for supermarkets. We also saw a lot of other supermarkets going out of business or closing or shuttering their doors and closing and kind of just making the footprint a little bit smaller. I see that happening as we move forward, where the supermarkets are actually going to be a little bit smaller in size, not so general, but more of a specific approach. Also, we're seeing supermarkets now entering a little bit more into the quick service restaurant game, and in some cases full service restaurants. We're seeing some of the new Whole Foods back east that actually have full service sit down restaurants inside the inside of the supermarkets. We're already seeing the Bristol Farms, the Gelsons, and Whole Foods also having a very large quick service restaurant or prepared food section, and we're seeing other brands such as Kroger compensating and adding that into it, including putting in potentially fast food pop-ups and Starbucks and coffee shops and such. The West Los Angeles submarket for office space has been pretty interesting to watch as of late. Over the last couple of years, we've had some very low vacancy rates that landlords have really taken advantage of by increasing the rental rates, and we saw a huge increase in general overall asking rates and lease rates for office space, especially in the Class A and Class B sectors. We're starting to see a little bit of a pushback there as vacancy rates are rising, where office tenants are moving to other submarkets within Los Angeles. Right now, the current vacancy rate is about 7.6% within the West Los Angeles market. However, both Class A and Class B are higher. They command a little bit of a higher rental rate, and their vacancy rates are typically closer to about 5% for Class A and about 4.5% right now for Class B submarket. Class C market, though, is experiencing great 3% vacancy rates, primarily due to the lower rental rates that they're charging. So overall, I see what's going to happen is that the prices have stabilized. I see them coming down maybe a little bit over the next quarter, not much, but overall, I think we're going into a pretty healthy office market in general. Well, I'd love to talk about the industrial market for the west side of Los Angeles. However, that has all but disappeared these days, being with a lot of conversions over to either a mixed use or creative office space. And so what we're seeing right now, however, is that there is really an increased demand because of that as well as other factors in industrial. In fact, I think the latest taglines of a lot of people is, can we actually build the industrial as fast as we need it? Especially smaller or mid-sized distribution centers where you see the e-commerce that's come up where they want to have their warehouses close by so they can deliver the goods that much quicker to the end users, the consumers. So we're seeing a high demand for that overall within the Los Angeles submarket, and I see that continuing as vacancy rates are still very, very low for industrial. So if you like what you saw today or heard today, please subscribe to our channel down below, and look forward to bringing you more content in the future.